Well, thanks very much, and good morning, ladies and gentlemen. It's very good to be here today. I was a little bit concerned a few moments ago during the coffee break when I saw large numbers of chairs being removed from the auditorium. So it is reassuring to see that a few of you have come back, even though you have retreated to a safe distance. I'm just reminded, a year or so ago, I was asked to come to Singapore to present on the subject of property investing in a post-crisis world, which I think was an interesting title at the time, and I did suggest that we weren't quite in a post-crisis world yet. And I think certainly based on some of Ronnie's comments earlier on this morning, and he would suggest that we're maybe decades away from a post-crisis world. So that was certainly a presentation ahead of its time. I think what I've been asked to do today is to talk about diversification across different global regions. It's something we're very familiar with at Aberdeen. We have a global multi-manager capability. We're big direct investors across different countries within Europe. And what I'm going to try and do over the next 20 minutes or so is to give a flavour of the way we see the world, perhaps touch on some of the issues going on in Europe at the moment, which I think is the focus of most people's attention, concern about the global repercussions of that, and then maybe to focus in a bit more on looking at the world from a Singapore perspective. So I'd just like to begin by talking about the financial crisis and the backdrop to property investing at the moment. So my first slide here, I think, is just a reminder of the uncertainty we face. Rather opportune again in the context of Ronnie's comments about the smelly consequences of what's going on in the Eurozone, as you can see from my cartoon on the right there. So I think these are things that we're very familiar with. The global financial crisis has prompted this era of austerity that's having repercussions through the rising tax burdens in many countries, the weakening labour markets. That has implications, of course, for occupational markets, for real estate, general reduction in investment flows, perhaps an increase in cross-border flows, as we'll come on to in a moment. Also increasing weight of regulation as the regulators scramble to catch up and perhaps legislate for things that they missed the first time round. So it's a particularly difficult investment environment, particularly uncertain. But of course, investors historically have thrived on uncertainty, and it's finding a way through the maze of opportunities and risks that is the opportunity for the future. I think in the mix also, the sort of geopolitical landscape is particularly fascinating and particularly challenging at the moment, not just within Europe. And you can see our 4 European leaders on my picture there. 3 of those have now been removed from office in Italy, in Greece, in France. And there are questions, of course, over even Angela Merkel's survival in the face of rising nationalism and dissatisfaction within Germany. It's not just that, it's other things like the broader geopolitical landscape, the Arab Spring and the repercussions of that, and even closer to this region, some of the naval skirmishes that we've seen in the South China Sea. So a very uncertain climate, but I think we're in historic times, and what's happening at the moment is particularly interesting in the context of what it means for investment. Well, where's Europe going? Of course, you can turn to expert comments. So I've picked 3 experts here, an academic, an analyst, and a politician, just to look at some contrasting views. So going back to 1997, perhaps a warning of foreboding from a US academic at Harvard, talking about the irreversibility of membership of the Eurozone. It was designed to be an unbreakable system. And he said that only in the face of a general economic dislocation or widespread collapse would the Eurozone fragment. Now, of course, unfortunately, we seem to be perilously close to some of those things. Now, the analyst response, a report from UBS last year, warning of the only way to hedging against a euro collapse is to completely avoid the Eurozone. Again, some fairly serious consequences suggested by that. By contrast, of course, politicians tend to be a little more optimistic, and Mr. Sarkozy thankfully tells us that the crisis is finished. There's no more risk that the Eurozone will implode, so we're fine. Unfortunately, he's no longer in office either, so maybe there was another kind of risk facing Mr. Sarkozy. I think this whole political challenge is one of the things to watch in Europe. I think a series of events, we've seen the Greek elections, that was regarded perhaps first time round as a turning point beyond which we'd be able to see which way Greece was heading. Were they heading for a euro exit or not? The second round of parliamentary elections hasn't really established that. I did see a headline in the UK papers at the weekend saying Greeks exit euro. That turned out to be something else, for those of you that have been following the football. If we look over the next few years, there are a number of milestones, a number of elections coming up. There are referendums on a variety of things. Even in the UK, the government seems to have got itself into a position where it may have to offer a referendum on the UK's membership of the European Union, which is something a smaller faction of ministers have been perhaps campaigning for, but it's the first time it's really gained a foothold. So I think what we're seeing is a rise of protectionism, a rise of nationalism, a big debate between the need for austerity and the need to stimulate growth again. And the fact is the politicians can't decide, the electorates are divided, and what we're seeing is a progressive removal of pro-European integrationist governments at precisely the time that it's increasingly clear that we need more fiscal and banking integration in order to keep the euro show on the road. So you've got this big tension between what's happening in the political environment and perhaps what needs to happen for the economic imperatives. So I think it's moved from being an economic question to being more of a political one. What happens in the political arena over the course of the next 2 or 3 years is going to be quite a fundamental part of the future of the Eurozone. Now, if we move beyond that and think about some of the real estate issues, I think most of these things are things that we'll be very familiar with, those of us in the room. So real estate, certainly with our global view, still looks like a relatively attractive asset class. We're still seeing reasonably strong appetite for investment from our investors. We have multi-asset clients, but real estate isn't a shrinking part of people's multi-asset portfolios. People are chasing income. They like the income that property offers. They like it to be well secured. That's one of the biggest challenges. They're de-risking portfolios, so moving away from the use of debt. Debt is harder to get your hands on anyway, of course, because of the squeeze by the banks on lending to property organisations. They already have far too much exposure to the sector already. So, of course, that in turn means that development is being squeezed. And longer term, if and when we get back to a growth environment, that'll mean that supply in some of the Western markets is going to be more constrained. So investors are refocusing on what property is all about. They're focusing on the underlying real estate, not financial instruments based around that. But what we are seeing, I think, is really a focusing of the market on a very narrow range of stock. It tends to be prime assets in a small number of global centres, long let, good covenants, and anything else is really being spurned by investors. So very much a two-tier market. It's a two-tier market geographically between key cities and the rest, and between prime property and the rest. So that in itself, I think, is suggesting perhaps a new set of risks and potentially opportunities as well. I think it's worth just a quick look at how different markets have been affected by the crisis. This is a chart that just looks at the rental cycle. The blue bars going to the left, it's the peak to trough fall in rental values from whenever the peak was prior to the financial market collapse, the Lehman collapse, through to 2008 and beyond, peak to trough, and then the recovery, if any, subsequent to that. So unfortunately you can see Singapore there is topping the league table of the declines, closely followed by Dublin, which won't be a surprise, I think, to anybody in the room. A number of markets have rebounded. Beijing in particular has really shrugged off that devaluation of rents. It's been more than made up by the subsequent growth. And the patterns of growth also, I think, are quite interesting. There are Asian examples in there, as you would expect, but also a number of European examples. So if you look at some of the Nordic cities, if you look at Brussels with the ever-growing demand from European bureaucracy, you see some recovery in some of those places. Unfortunately, other locations like Dublin, like Tokyo, very little sign of any recovery at this stage. So the crisis has had different effects in different places. If we look at market sentiment now, this is looking at the expectations for capital growth over the next 12 months. It's taken from quite a wide-ranging survey of different investment managers, different forecasters. And essentially what this is saying is if the lines are above the neutral line in the middle, there's a general balance of expectations in favour of growth and in favour of decline if it's below that line. So you can see, turning the clock back to 2008 or thereabouts, everybody everywhere thought values everywhere were going to fall. So a pretty miserable picture, certainly the like of which we hadn't seen in that time series. There was a rebound subsequent to that, and of course what we're seeing now is a rounding down of expectations. Certainly the UK is firmly back into negative territory. Japan's sort of wobbling along the neutral line, and a cooling off of sentiment in other areas as well, perhaps Australia and the US holding up better than most. So certainly a shift in sentiment. It's not particularly negative, it's not positive either, but I think there are certain questions over the sustainability of appetite for property against this climate. But generally, as I've said earlier, the investors are looking into a multi-asset context, and in that context, with the uncertainty facing other financial markets, property still looks a reasonable opportunity. So I suppose the question is where we go from here. So my next chart is just showing Aberdeen's forecast for a selection of markets, and there are some quite important markets missing from this. These are essentially markets that have broadly measured track records, generally have indices. And so what we're looking at here is a combination of rental income and capital growth. It's the total return expectations for a portfolio of assets, unleveraged, in local currencies over the next 5 years. So you can see, again, a spread of opportunities here, some themes coming through, so 3 Anglo markets at the top there, 2 of which are commodities driven. Again, picking up a theme from earlier on, Australia and Canada are economies that have managed to avoid the worst of the recession. They've also reaped the benefits in property market terms. Both markets have been relatively strong recently. The US is perhaps a slower burn recovery, and a number of shadows, of course, over US markets, a very diverse, very large market, and it's very difficult really to generalize sensibly about it. But certainly we expect a steady recovery that is beginning to attract new capital from around the world. At the bottom end of the league table, again, some markets that won't surprise you. So Italy and Portugal taking the wooden spoon as far as the Europeans are concerned. If we move on to investment strategies to address this, I think increasingly we're seeing a shift to cross-border investing. I think typically what happens in a crisis is that investors batten down the hatches, they focus on the domestic market, and the larger and more diverse the domestic market, then the less the appetite to diversify internationally. But what I think is interesting this time is that was only a short-lived phenomenon in the earlier stages of the crisis. And I think what we're seeing now is a much greater realization that there are global opportunities. And we've seen perhaps false dawns in globalization of property before. We're probably at least 20 years behind equities and fixed income markets in terms of full globalization. But I do believe that we're on the threshold of something much more like that now. I think the delegate profile at this conference and the way that's evolved over the last few years is symptomatic of that. It's surprising how many people I've already met here that I've met in other places around the world. So it's becoming a more integrated global community for real estate. Now, typically, the way people address that is that they look at the domestic market first and think about how to diversify beyond that, usually in terms of the opportunity to add to returns. And the smaller the market, the greater the opportunity set outside the home base. And the chart on the left there is just showing the global market share of investable stock in a variety of countries. And so countries like Canada or Australia that only account for something like 3% of the global market. Of course, the domestic market is somewhat limited if you have a big capacity to invest. So it's not surprising that there are cross-border flows and opportunities to do that. Now, of course, One of the challenges in doing that is that you have to decide what platform you're going to use to access international markets, and that's something I just want to explore in a little more detail in the next few minutes. Just in terms of the opportunity set, I think it's worth looking at the spread of returns year by year that's been delivered. And again, this is with the caveat that this is restricted to markets that are measured in that way, that have a market return index. And all this is showing is the spread across global sectors and countries between the best performing segment and the worst performing. And what that's telling us is that in almost every year, regardless of the state of the market, it would have been possible to earn returns of about 20% or often more than that. Equally, if you wanted to thrash yourself with nettles and lose money every year, you could have done that as well. What that's doing, though, I think is showing the breadth of opportunity, perhaps also the risk of getting it wrong. So the wider the opportunity set, the greater the opportunity to deliver stronger returns if you make the right choices. Now, in terms of how investors have done that, I think traditionally history suggests it hasn't been terribly satisfactory. This is showing a traditional approach to international investment, and on the right-hand side, some thoughts about how we might improve on that. The traditional approach, as I indicated a moment ago, is typically driven by local assumptions about real estate. So how much of my portfolio do I want to put into real estate in the context of domestic returns? And then are there opportunities to enhance those returns by investing in other markets? That's typically the rationale. Now, in terms of accessing those markets, of course, the opportunities are limited by the resources that you have at your disposal. So very few investors have the luxury of a local property platform. They have to rely on external fund managers to do that job for them. And the moment you get into that arena, of course, you're buying into funds, you lose direct control. Many of those funds have high leverage in them typically. That changes the investment characteristics, and it may well change the investment rationale for investing in the countries you thought you were targeting. And a lot of investors perhaps haven't taken into account fully the shift in risk profile from their entry point into those markets. Now, that can be a recipe for disappointment, and for many investors, the scale of the downturn and the effect of leverage on returns as capital values fell was particularly devastating and uncomfortable. So the question is there another way? Many of those constraints about the lack of local platforms, of course, remain. Well, I think the shift of emphasis that we're seeing is more of a shift away from a focus on return and a much greater focus on risk. And certainly I would argue that it's within a fund manager's remit to be able to control the risk that we put into a portfolio much more effectively than we can control market returns. In fact, you simply can't control what the market does. You may have views, you may be able to steer around some of the rocks by avoiding markets that your forecast suggests are going to cause pain in the future. But the one thing you can control effectively is the type of risk you put into a portfolio. So a risk budgeting approach makes a lot of sense. Also, I think it makes a lot of sense to look at the domestic allocation in the context of global markets rather than the other way round. So looking at global market opportunities and looking at the adjustments that you have to make for tax leakage, for volatility from other sources like leverage, what returns are you really going to get in each market? What share of that global market should you place domestically? And generally, I think our analysis suggests that will help to protect you on the downside. It will lead to enhanced returns over a cycle, and in particular, it leads to improved risk-adjusted returns. And I think it's the focus on risk-adjusted returns rather than absolute returns that is right at the heart of this kind of approach. Now, in terms of the things you need to consider in building a global portfolio, I think a lot of these things are very familiar. Again, different entry points on the right-hand side, depending on your platform. It could be listed stocks if you want a very hands-off approach, but recognizing that listed securities behave like other listed securities. The fact that some of them are linked to property may be no more than a passing relationship, except perhaps over longer periods of time. There are various non-listed routes which range from commingled funds of funds through to different styles of individual fund which you might select directly. There's direct ownership, where you may have a dedicated portfolio, a segregated account run for you by a manager with the local platform, or ultimately for the very big investors like GIC that have offices around the world, they can also contemplate direct ownership as well. I think direct ownership is an interesting one because a number of Asian investors are certainly going straight down that route, and part of this polarisation effect that I mentioned earlier is that many investors are trying to access, for example, central London offices. It's a market they feel comfortable with. It's big, it's transparent, it's well measured, relatively stable platform, but it's not necessarily a safe haven, as I'll come on to. The factors on the left-hand side essentially are the building blocks to consider in building this international portfolio. If we move on to look at some of the investment characteristics, I think this is a chart based on some analysis that we did recently, looking at the income side of the equation. Many people are, of course, focusing on income as the thing you most want to defend. And what we've done here is to plot along the bottom axis the yield on properties in different markets, so effectively the income return, and then the volatility of that income up the left-hand side over a 10-year period. Now, Singapore emerges immediately in the top left-hand corner as a volatile market, and you saw that on my chart earlier. It had the steepest decline, peak to trough, in rental values of all the cities on that chart. It's also low yielding, so you could say that the sector to avoid is the low yielding, highly volatile quadrant. And a number of Asian cities in that top left-hand corner. One unfamiliar Asian city is London's West End market. So we would certainly question whether London is really a safe haven. It is a very volatile market. The flip side of its liquidity and transparency is a volatility that is in a different league from many other markets. Now, you could argue the place you most want to be, therefore, is the bottom right-hand corner. Safe haven markets with high income, low volatility, like some of the Australian cities. But then you can see Athens and Lisbon have sneaked in there as well. Hardly safe havens in the current environment, I would suggest. So that there's an insolvency risk, there's a tenant default risk there that is not factored into the standard analysis. So this is quite a complex picture. In looking for safe havens, there are a number of factors to be considered. Also, there's the question of whether you need to go global to diversify. I think the answer is, in reality, you don't. You can get good diversification in a domestic portfolio by virtue of the fact that different markets behave in different ways, and every building in a portfolio is different. I've categorized the market into regional groups and global financial markets, and this is looking at the world from a Singapore perspective. It's looking at the correlation between returns on assets in Singapore, focusing on offices, with other cities. So if you look at global financial centres, you'd expect them to cycle broadly at the same time, and sure enough, there's a reasonably strong positive correlation with some of those cities, but not with Hong Kong, where there's a negative correlation. If you look at correlations with cities around the world, you can see relatively high correlations in each region. So in North America, Vancouver, which is the entry and exit point for Asian imports and exports, highly correlated with Asia. You might expect that. At the other end of the spectrum, you've got other Canadian cities that have very low correlations. And even within Europe, there are highly correlated markets and lowly correlated markets. So a diversification story, again, is quite a complex picture. There certainly are opportunities globally, but you can find them closer to home as well. So in terms of how we manage risk at the global level, I think part of the story is the asset diversification. I think you can see enormous spreads of returns in any markets, the fact that buildings are so different in any market you look at. So this is really the stock selection story, the range of returns you could find in each of these markets in a year I picked at random, 2010. So in 2010, you could earn strongly negative returns in most of these markets. You could even get positive returns in double digits in Spain. There's also the question of leverage. Now, again, most people have been de-risking portfolios, taking debt out. You could argue that at a point where interest rates are at a historic low level, it could be a time to put debt back on. Well, I think our question would be, what do you use debt for? Our research suggests that whatever you do, the more debt you put into a portfolio, the more risk-adjusted returns will decline. So the chart on the left shows absolute returns in a period of positive returns and the effect of leverage, which shows a steep rising curve if you look at the absolute return effect. If you look at the risk-adjusted return that takes volatility into account, you see a steady decline. Now, there are ways perhaps of diversifying risk through growing your portfolio through using debt. You can buy more assets, you can buy bigger assets, but the effect on our analysis is still the same. The risk-adjusted return will decline. So there is a question of what debt is all about. Certainly there's a suggestion that if you buy more assets rather than bigger assets, you can achieve some diversification effect, as you can see on the right-hand side there. But debt is a dangerous weapon in a way. It's great when markets are rising, but in the current uncertain climate, it can certainly be a burden as well. So in terms of managing risk in the portfolio, I think the approach that we've adopted is to look very closely at a variety of different things. I've identified three areas which I think are particularly important. Firstly, market mispricings. The chart on the right-hand side suggests mispricing effects across a range of different markets. In our view, they are somewhere near the fair value range at the moment. The weakness in a number of markets is creating some value. The question is, of course, whether markets have further to go downwards before they start recovering again. So we look at a range of leading indicators, a lot of current market information from our dealing teams, our letting teams on the ground to try and identify where markets are at the moment and also market momentum going forward. So this is looking at survey data, real-time data, not just longer-term forecasts, which they may give you a broad view over a period of time, but certainly their short-term accuracy is highly suspect, particularly in a climate like this. And of course, matching strategy for each portfolio to the real risk tolerance of any given client. So those are the three areas I think to focus on. Just to round off, I think in this uncertain climate, what do we need to focus on to steer through the storm? Again, I think the background is very clear. The recovery prospects in all Western markets, I would agree from the discussion so far, it's questionable. The recovery will be slow, it'll be very patchy. There will be considerable pain in some of those markets as we go through the next year or two. And at the heart of that question is what happens with the Eurozone and its potential fragmentation. The polarization of the market, I think, is also creating more overheating in certain areas. So this flight to quality and the fact that so many funds are trying to do just the same thing, targeting long-let assets, prime assets in a few gateway cities, that's sowing the seeds for overpricing once again. And it is interesting to look at institutional quality stock in regional cities where the local institutions have been more than happy to invest over long periods of time. A lot of global investors simply aren't looking in those locations, and in many of those locations we think there's a lot more value to be had. There is also the question about what global diversification adds. In our view, it can certainly add to the opportunity set. It doesn't necessarily add up to a correct solution for every client. So we would certainly explore opportunities at a global level for most of our clients, but it may not be the right solution in each case. So our strategic themes are to focus on the more transparent markets. That's by virtue of the risk profile of many of our investors who tend to be core to value added. These are long-term investors focusing on income. The focus is really on income growth through active asset management where that's appropriate to the risk profile, but in particular the protection against the downside risk of capital markets and also the risk of losing income in this very uncertain environment. In that climate, we're certainly focusing on very limited use of debt. So I think that's a global gallop through a number of themes. I think hopefully will set the scene for some of the other discussion through the course of this conference. I just thank you for your attention.
Thank you, Andrew.